Hey everyone, and welcome. Today, we're going to break down a really powerful tool that every trader should know about, the exponential moving average, or EMA for short. We're going to see how this one little line on a chart can help you find actual trends inside all of that market noise. Let's get right to it. I mean, think about it. Prices are bouncing up, down, sideways. It's just a constant stream of chaotic information. So, the big question is, how do you spot a real tradable trend before it's already over? Well, that's exactly the problem that technical indicators like the EMA were invented to solve. So, here's our game plan for today. First up, we're going to decode what the EMA actually is. Then, we'll get into the classic crossover strategy. You've probably seen this one before. After that, we'll level up and look at some advanced combos for getting stronger signals. And we'll wrap it all up with a much-needed trader's reality check. All right, let's jump right into Section 1, Decoding the EMA. We've got to understand the basics of what makes this indicator tick before we can really put it to work. So, what is this thing? Well, the exponential moving average is a line that follows an asset's price, but here's the key. It gives way more importance to what the price is doing right now. It's almost like it has a short-term memory. It cares a lot more about recent action than what happened weeks ago. And that's what makes it so quick to react to what the market is doing. Now, you might have heard of its cousin, the simple moving average, or SMA. The big difference is right here. The SMA is, well, it's simple and smooth. It treats all the price data equally. But the EMA, it's all about being responsive. It reacts way faster to new price changes. And that's exactly why traders who are looking to catch new, short-term trends just love it. And here's what it looks like on an actual chart. See that blue line that's kind of hugging the price candles? That's a 9-period EMA. A period just means the time frame you're looking at, whether it's days, hours, whatever. Day traders really like this 9-period EMA because it hits a sweet spot. It's fast enough to catch quick moves, but not so fast that it's just noise. Okay, now for Section 2. This is where it gets really fun. We're diving into the most famous EMS strategy out there, the classic crossover. This is all about how two simple lines crossing each other can signal a huge potential move. The idea here is honestly super simple. You put two EMAs on your chart. One is a fast, short-term one, and the other is a slow, long-term one. And here's the trick. You basically stop looking at the price itself and just watch for one thing. The moment those two lines cross. That crossover, that's your signal. Check this out. On the left, when that zippy, shorter-term EMA shoots above the slower, longer-term one, that's your bullish crossover. It's a sign that upward momentum is building. A potential buy signal. And on the right, you see the flip side. The fast line dives below the slow one. That's a bearish crossover, telling you it might be time to sell. So what's the magic combo? Well, there isn't just one. It really depends on your game plan. A day trader, who's in and out on the same day, might use a quick 9 and 20-period pair. A swing trader, who holds on for a few days or weeks, might be looking for something else. And then you have the big one, the 50 crossing the 200, often called a golden cross. That's what long-term investors watch for as a sign of a major market shift. All right, let's move on to Section 3, because just using one signal can be risky, right? So this is where we level up. We're going to see how smart traders combine the EMA with other tools to get a much stronger, more reliable signal. You know, the biggest goal here is to avoid those dreaded false signals. An EMA might cross, but if there's no real power behind the move, it can fizzle out instantly. That's where an indicator like the RSI, the Relative Strength Index, becomes your best friend. Think of it like this. The EMA points you in the right direction, and the RSI tells you if you've got enough gas in the tank to get there. So here's a pretty popular strategy broken down into 3 simple steps. First, you only look for trades when the market is in a clear uptrend. You confirm this with your big EMAs. Step 2, you wait for a little dip, a natural pullback, which you can spot when the RSI drops low. And finally, step 3, you pull the trigger when you see a strong bullish candle, confirming the pullback is over and the trend is back on. So what's the actual recipe here? It's these 3 key ingredients. You've got the 50 EMA as your medium-term guide, the 200 EMA to make sure you're on the right side of the long-term market, and then the 14-period RSI to help you nail your timing and confirm momentum. And what can this actually do? Well, when this exact strategy was backtested on the Euro-US dollar pair, it showed a win rate right around 55 to 60%. Now, obviously, past performance never guarantees future results. But what this shows is how combining tools can create a small statistical edge. And remember, that edge only works if you let your winners run and cut your losers short. And that brings us to our final and honestly probably the most important section of all, the trader's reality check. Because no indicator is a magic crystal ball, and you absolutely have to know the limits. I really want this quote to sink in for a second. No matter how good your strategy looks, it is going to have losing trades, period. That's why managing your risk is everything. Things like setting a stop loss, which predefines your maximum loss, isn't just a suggestion. It's absolutely non-negotiable. So let's just lay it all out. The EMA's greatest strength, how reactive it is also its biggest weakness. In a nice, trending market, it's amazing. But when the market is just chopping back and forth with no clear direction, that same reactiveness will give you a ton of false signals and drive you crazy. It really needs a trend to be effective.
So the takeaway here is pretty simple. You have to be smart about how you use it. Only use it when the market is clearly trending. Always get a second opinion from another indicator, manage your risk on every single trade with a stop loss, and hey, play around with different settings, find the EMA periods that really click with your own personal style.
And that leaves us with this final thought. Since the EMA is built on past price data, it can't actually predict the future. No indicator can. But what it does, and what it does incredibly well, is help you see the present with so much more clarity. It helps you understand the flow of momentum right now. So it's not about fortune telling, it's about making better decisions in the moment.